Okay, everybody that's using stocks and bonds in their portfolio, and that's it. We got a conversation to have. And if you don't know this by now, bonds are not a diversification of stocks, and I can prove it. Let's go through this, right? So we've always used bonds to diversify stocks. When stocks are going down, the bonds are our savior. They're just nice and solid, paying us interest, not losing money. Until you finally got the message in 2020 when the stocks and bonds went, sorry, 2022, when the stocks and bonds went down together. I've been screaming this since 9/11. We have to look at this very closely. So here's what the economists say. When the market expects borrowing costs to climb, meaning when the market thinks interest rates are going to rise, the correlation between stocks and bonds typically increase, meaning they begin to start moving with each other. Okay? So, from a mechanical perspective, cash flows are discounted by investors at higher rates, thereby decreasing the current value of both stocks and bonds. Think 2022. That was the fancy speaking of what happened in 2022. Moreover, higher interest rates often dampen consumer and corporate spending, meaning we stop buying as much. We see higher interest rates. We're not buying houses like we all stay in our houses, and that's what happens. Okay, so we stop consuming. We don't stop, but we slow down our consuming, which hurts the companies, and the companies can't borrow money to grow their business because it's too high of cost. So things slow down. Okay, so that's the economics of it. So let's, the standard teeter-totter when interest rates go up, the value of bonds go down. When the value of bonds go up, the interest rates are going down. So we have to understand the correlation to interest rates, and they're not supposed to be correlated to stocks. But let's think about this. We had some inflation, so we had to rise interest rates, which hurt the stock market and hurt the bond market, right? Now we have higher interest rates. And what's the only reason we're going to lower the interest rates? Oh, if the stock market goes down, then the interest rates will go down. Okay, which will then in turn help the bonds go up. But when we have low interest rates, we go into a boom. Look at every time we've lowered interest rates, what's happened to the stock market? It's rocketed out of it. So we're going to start seeing these correlations, but I want to show it to you because I think it's been going on since after 9/11. Because I then take these economics and say, okay, wait a second. Once interest rates relatively hit zero, isn't the market always expecting interest rates to be higher at some point? We can't go any lower. So the reality is you look at a chart of the S&P versus the total bond return index. It's very simple. You go back to in the beginning of this chart is when 9/11 happened. You got 2000 there and all the way through January of 2025. So go back to the 2000 and notice the yellow line is going up as the stock market is going down. Okay? That's the last time we saw that happen. That's right. 9/11 was the last time we saw a negative correlation. That's what's amazing to me. And the people calculating this, and you can give me arguments that I'm wrong. I'm fine with that. But when 2008 happened, bonds went down. Now we can go look at yearly numbers and we're not going to see as drastic, but just look at the charts. When 2008 happened, bonds went down. When the pandemic happened, bonds went down. When 2018, we had a little mini crash at the end of the year, bonds went down. 2022, bonds went down. Look, I got to be honest. When I look at this chart and I look at bond returns versus stock returns, I'm telling you there's a correlation. Because when I look at uncorrelated assets, they don't look like this. When I look at negative correlations, they don't look like this. Bonds are not a diversification of stocks. And I think we can all agree, especially for the last 15 years, stocks have had a much better return than bonds. I think we can all easily agree on that. So if they're correlated, meaning they move together, Why do we have bonds in our portfolio? Stocks have a better return. So we got to think through these things. This is so important that we understand this. The world of investing is about building a portfolio where you can have higher return with less risk. And that was the idea of having that 60-40, 50-50, 40-60 portfolio. Stocks and bonds, you got to have that. They're not correlated. They help each other. No, hogwash. Hogwash. Since the early 2000s, they have not helped each other at all. Bonds have been the dog for a quarter of a century. That's right, a quarter of 25 years now they've been terrible, and it was obvious. It was obvious to the vast majority of us paying attention. Okay, that's the reality of it. I know plenty of financial advisors out there that have bonds in their own portfolio because they're completely deluded and don't understand investing at all. Those are the only advisors I know with bonds in their portfolio. That's the reality of it. So now let's take a look at this. When we really dig into the principles of investing, Harry Markowitz was the first one really talking about non-correlated assets and talking about diversification and how it helps you. But really, Ray Dalio has furthered that into the holy grail of investing. And the key is non-correlated assets, non-correlated investments that don't move together. They move in all mishmash, no correlation. A negative correlation is opposite movement. No correlation is just completely random. Has nothing to do with each other. Okay? Non-correlated. Now, when we start putting together non-correlated investments, if you have a standard deviation of 12% in an investment, and that is your entire portfolio, well, you're going to expect volatility. That's the reality of it. You add another investment to this mix, add 12%, you're going to reduce the volatility of the portfolio because sometimes when one's up, the other one's down, the other one's up, and they balance each other out. So you're going to reduce the overall volatility of the portfolio. Add a third, add a fourth. You've reduced the volatility in the portfolio by 50%. This is a magical world of a perfectly uncorrelated asset. Okay, 4 completely uncorrelated assets reduces the volatility by 50%. If you can find 10 completely uncorrelated investments, you're reducing the volatility by 80%. Okay, bonds are not an uncorrelated asset, and certainly different stocks are not uncorrelated assets. So what do we know from this? What do we learn from this? Well, diversification with uncorrelated assets, so important. That's what reduces the volatility in the portfolio. That's what increases the performance of your portfolio. Bonds are not enough to properly diversify a stock portfolio. More correlated assets, more stocks. Oh, but I do small cap and large cap and mid cap and international and this and that. No. Go look at their correlation. Oh my Lord, they're the same. Our whole stock market moves together. It's ridiculous. Now, certainly are there outliers and are there occasions where one stock goes down and the rest of them are going up? Yes. But the grand movements of our markets are all in general. So the reality is stocks are correlated, especially when you're looking at the categories of stocks. They are absolutely correlated. That does not diversify you. Certainly it does from a risk standpoint. I'd rather own 500 stocks than one stock, depending on what that stock was. If that stock was NVIDIA in 2024, I'd rather own one stock. Can have that argument all day long. So Ray Dalio talks a lot about the diversification of uncorrelated assets. And unfortunately, in the world that those really, high-end, super rich advisory world people are, they invest in ways that none of us have access to. None of us normal people. You've got to be a billionaire to get into that world. They have minimums of $100 million, investment. And oh, by the way, you're not going to have access to that money for years. And when you do have access, it's small amounts. You're going to have to put it on sale and find somebody to buy it from you to do it. So what the diversifications that can be utilized by most normal people, and all these big advisors understand this, is things like precious metals. Gold has been a fantastic uncorrelated asset to add to a portfolio. In hindsight, especially the last 25 years, oh Lord, I would have much rather owned gold than bonds. Without question, it keeps up with and you can test different time periods and all that, but from 2000 to today, it kept up with the S&P 500. So the reality is it's a great diversification for a portfolio, and it's very uncorrelated to stocks. That's a great thing. Commodities, you can add some of that in there. Real estate, think about your whole life, not your stock portfolio. Don't go buy REITs because I said you got to add real estate to your portfolio. You own a house, hopefully, and this is your motivation to buy instead of rent. Real estate has been an absolute fantastic investment category. That's owning rental properties, owning second homes, owning your primary residence as opposed to renting. It's fantastic. Okay. Infrastructure. There are funds out there. There are closed-end funds, mutual funds that are investing in the infrastructure world you can add. Fixed investments like CDs and MYGAs, multi-year guarantee annuities. Fixed index like the structured notes that are out there, the indexed CDs, and more popularly, the fixed indexed annuities. These are different categories. Think about these, their floor is zero. So when everything else is going up and down, these are doing just fine. And when things are going well, you're earning more. These are diversifications that we can all utilize. Cryptocurrencies, right? Ray Dalio is pretty hot on gold and cryptocurrency, which is a little surprising on the cryptocurrency side, but he's been right so far. And, look, it may not be right for, say, a retiree, but if it's a retiree that has a big portfolio that needs some extra diversification and it's not money they need right here, right now, it is a diversification. You certainly can utilize these things in the right circumstances. This is not right for everybody. You still have to build a practical portfolio to fund your own needs. But if you're in growth mode or you're in I'm giving this all to my heirs mode, then certainly we should be looking at better diversification. All right, I hope that helps. Bonds are not diversification. You've got to go beyond bonds. Give me a call, shoot me an email, whatever you can do. You can always reach out, yourinvestmentcounselor.com. I'm happy to meet with you. We've got 30-minute free meet and greets on there. I also do full form classes over Zoom live. You can do Q&As, all that stuff. FPFEAZ.org is the website. You will find the full class schedule on there. Like, subscribe, go see our full channel, over 250 videos and new videos every single week. Thanks again. We'll see you soon.